markets. But let's get to James Gerrish from Shaw Partners and Market Matters. He joins us now. James, welcome. I would like to just talk about the setup for this session. I mean, to say that that was a fall on Wall Street is understating it. We haven't seen falls like that for quite some time. What's your perspective?
Yeah, good morning to you, Nadine. It was the most aggressive sell-off since December. So clearly, it's all around, as you just alluded to, the expectation around interest rates going forward. The market, January's rally was built on the fact that there was this view that the Fed was going to pivot, the RBA was going to pivot, inflation had peaked, and central banks were going to put their foot off the gas. That hasn't happened, and bond yields have continued to push higher. The US 10-year, really strong overnight. So that's caused a reasonable sell-off in equities. We're down, 40 odd points on open. So not as bad as what we saw over in the US, but still a down day nonetheless.
Okay, so we'll be preparing for that, but we will be digesting a lot of these reports that have come through. We've just mentioned Woolworths and Dominoes. Dominoes is a very severe reaction to that disappointment. I mean, what does that tell you in and of itself that we're seeing such a significant reaction to any of these disappointments?
Well, I think it's warranted in terms of Dominoes. So, obviously there was some optimism that the worm had turned in terms of Dominoes sales and earnings and the like, but that just hasn't simply been the case. So, the market was looking for profit for the half, somewhere around that 76 million. They've come in about 16% below that. Same store sales are going backwards. The top line is going backwards as well. They're dealing with sort of two ends to that curve. So obviously, weaker sales, but then they've got higher input prices, which are, really crimping already thin margins. So Domino's was still trading on sort of 30 times earnings. It's still on a growth multiple. It's a stock that's not growing. So, you can understand it's trading down 20% right now, trading at 56.91 at the moment, Nadine. So I think it's a completely understandable reaction for Domino's result today.
Okay, well, we will continue to watch that one. Things can go south pretty quickly, especially when you're priced for what some would say perfection. So speaking of, that brings me to Levisa. Now, I know that this is a much loved retailer across many groups. So Lovisa is down by 3% in the wake of its result. Can you give us the update? What's your take? Because just going by memory, I believe it's one that you may hold.
Yeah, we've actually we sold it probably 6 weeks ago now, Levisa. So you're right, it is down on the session, but it was a pretty good result. So their revenue was up 45% for the period. That was a really strong outcome, and I think one of the things that they highlighted as well was same-store sales or comparable sales growth was still tracking at 12.5% for the first 7 weeks of the year, which is about what it was tracking at for the full, for the first half. The first half comparable sales growth was about 12.3%. So, look, it looks like they've got 740 odd stores now. They've opened, I think it's 40 odd stores since December 31. So there's a lot of growth still happening in Lovisa. The model works. You just made mention earlier of things being priced to perfection. Lovisa is probably that. So a little bit of profit taking into today's result, but I wouldn't be too concerned about it, Nadine.
Got it. Okay, so that's Lovisa. Can we talk Flight Centre, saying that the recovery is gaining momentum, profit coming in ahead of expectations, and positive margin trends as well. Clearly, it's made an acquisition as of late, and says that recent FY23 guidance was reaffirmed. No signs of a slowdown in the initial part of the second half. Will travel be immune to a consumer spending pullback?
It's a good question. There's not a lot of new news that came out of Flight Centre today. I'm noting the shares are down 4.5%. So obviously I'm missing something in terms of that. But they made the acquisition of Scott Dunn, 211 million, to push them more towards that the higher end travel market that's less susceptible to changes in consumer spending and higher interest rates and the like. So I think that acquisition makes sense. The detail they provided when they were making that acquisition was strong. So there's not a lot of new news that I thought came out today. Their guidance reaffirmed is pretty much where the market is. So EBITDA of 275 million is where the market is, and that's what they've come out and said today. So it looks a good result, but again, it's run hard into it, and perhaps some a little bit more expected in terms of Flight Centre. I think it's a trend that we've seen this reporting season to date. Those companies that have run hard into the results are the ones that are at risk of being sold off. Like Altium is a stock that we own and reported yesterday, a touch soft, but it got sold off reasonably hard yesterday because it has been strong leading into the result and outperforming the sector more broadly.
Yeah, I thought that was a pretty severe reaction to Altium as well when the numbers looked good. Well, I can say that Flight Centre shares are down by about 4.5%. Worley shares down by 1% early in this session. Again, when you're looking at the figures, we've got revenue up 19%, underlying earnings up 13%, margins slightly lower. On a statutory result of let's call it $5.4 billion, and that's up. So, again, what's going on with the Worley commentary? I suppose it gives you some sense of what's to come.
Yeah, I mean, you think about Worley as a business, and we hear a lot about the path to decarbonisation, and Worley is certainly a business that is front and centre in that, is going to be pivotal in that decarbonisation process over the coming years. But you think about that revenue line, so nearly $5.4 billion for the half. They've done profit of $154 million. It's up 3% on the period, but 154 million profit on such significant revenue shows you how slim those margins are. They've basically said that their full year numbers are aligned with consensus. So consensus is for 10.8 billion in revenue, dropping to a profit of about 338 million, I should say, is what consensus is. So that's they're razor slim margins in terms of what this business operates on. It's always been that way, and it's the how those sorts of businesses operate. But gee, it's a challenge. It would be a very challenging business to operate in. And despite all this rhetoric around decarbonisation and how much demand there will be for Worley's expertise, it's still not translating into rising margins. And I think that's probably the issue with the result today, that margins have slimmed down, no doubt, on the back of wage inflation.
Yeah, well, it does lay out in its outlook revenue growth and margin expansion expectations. So it's obviously very aware of that pressure being put on its share price in terms of those margins. But yeah, talking about just, the geopolitical environment really elevating concerns, it's expecting its underlying EBIT margin to be really similar to that of FY22. Let me see, have I hit all of those on the list? What else? Is there anything else that's really standing out to you this morning, James, that we should be aware of?
Yeah, I mean, Reece is out with results, so they're obviously exposed in the building products, plumbing side of things. They're saying they're still seeing a continuing slowdown. So first half was good. The numbers for the first half are actually pretty much in line with expectations. They're reasonably strong. They are saying that sales volumes have slowed in the second part of the second half. The second part of the first half, and that trend has continued so far in the second half. So the market is already expecting a slowdown, a reasonable slowdown in that business. They've more or less confirmed that. Stocks trading down 1%. I'd say ReadyTech was the other one that we were across this morning. RDY, a smaller software business that's reported a good set of numbers. The revenue line is slightly below where we thought it was, but we think that's going to be more of a timing issue, and they've reaffirmed their full year guidance as well as some of these longer dated aspirational targets they have. So that's one that may get sold down but should be bought into weakness if that plays out, Nadine.